take care of some quick housekeeping things. If you guys can let me know if you can see and hear okay, that would be extremely helpful. And along with that, if you have any problems seeing or hearing during the presentation, please just send me a message in the chat box and let me know. My name is Ellie. I work for Sales Tax and More. We're really excited to be here today. I know some of you guys have been at our other webinars. We do have a series. We offer free CPE credit for all of them. And that being said, I have a few things to go over. So if you are here for CPE credit, we need you to do a couple things in order to receive that CPE credit. So the first thing we need you to do is to answer our poll questions as they come up on your screen. If you have any problems with that, please just send me a message and let me know. We also need you to fill out the survey at the end of our webinar. There are a couple ways you can do that. So a pop-up will come up on your computer. You can fill it out right away. If pop-ups are blocked on your computer or you don't have time, don't worry. In 24 hours from today, you'll receive an email with a link to the survey that you can fill out. You can fill out then. In that email, you will also receive a link to the slides, along with a link to the slides that I will send out in the chat box here. And in addition to all of this, if you want to go to the next slide, Mike, if you have any questions as we go along, please ask us. Just hover your mouse over the center of the screen and click on the Q&A panel. Ask us your questions. If we don't get to your questions during this webinar, we will follow up with you via email and get your questions answered. So please reach out to us if you have a question we want to answer. And again, another reminder, we will be sending out the slides. Once the ball gets rolling here on the webinar, I'll link them in the chat box as well. So let's do a quick introduction for Sales Tax and More. Sales Tax and More, we are a full service consulting and solutions firm. We have a team of experienced tax professionals, and we are very dedicated to fulfilling your state tax related needs. So we do a lot of returns, registrations, consulting, research, and like our name states, more. So if you have a question about the services we offer, please reach out. We'd love to answer those questions. And let's do a quick introduction for you here, Mike. Mike, state tax knowledge is very well-rounded. He's one of the United States' leading authorities when it comes to e-commerce, Nexus, service providers, and drop shipping. Over the year, he's assisted thousands of sellers, both foreign and domestic, with their tax issues. So Mike, if you want to take it from here, we can go ahead and get started. You'll be hearing me during all of the poll questions today. And yeah, thanks, Mike.
Thanks, Ellie. Okay, so we've got a lot to cover today, and we're going to start off with a definition of Nexus, and now we're going to talk about sales tax Nexus a little. And we've had some people say, well, you know, when someone's coming to this, don't they already know about sales tax Nexus? And yeah, reality is not everyone. So we're going to, you know, do some comparing and contrasting and let you know about some of the differences between the two. And we, you know, feel that we need to cover the sales tax Nexus in order to be able to compare it to the income tax Nexus. So we're going to start off with sales tax Nexus. For those of you who have been to some of our previous, this may be a little bit of a review for you, but again, I don't think that you can hear this stuff too many times. It's that important. We're going to talk about Public Law 86-272, or the Income Tax Act of 1959, the Interstate Income Act of 1959. And whenever you're talking about income tax nexus, this is paramount. So we're going to talk about that a lot today. We're going to talk about materiality. We're going to briefly touch on the Secretary of State, and then we'll, you know, go to some common myths, and then also hopefully open it up to questions. Now, in case you noticed, I talk with my hands a lot. I get a little bit, you know, looking off into the distance there. So I am going to, when we get to the meat and potatoes of the presentation, I'm going to shut it down because I find it very distracting. But let's go to the first poll question before we shut it down, Ellie. All right,
Yeah.
so the objectives today, we want you to understand that there are different Nexus standards for income tax and for sales tax. We want you to know that there are protections from this federal law out there, but it's a federal law from 1959. It's 60 years old. It's got limited protections. So we want you to realize that based upon today's economy, a lot of companies just won't get these protections, and we'll go over those. And then we want you to understand why either your client's exposure is or where your exposure is and where it isn't. With all of this economic nexus for sales tax, I'm hearing a lot of half-truths or just outright, misconceptions. So coming out of this, we hope that you'll know all of these things. And the worst time to find out that you have an issue, whether it's for sales tax or income tax, is when you're being contacted for the state. By the time that happens, your options are very limited. If you're proactive, then you have a lot of options. But once the state finds you, options are limited. All right, so Ellie, here's the promised first poll question.
Absolutely. I'm launching that right now. So again, here's your first of many reminders that if you're here for CPE credit, you do need to answer these poll questions in order to receive that CPE credit. We want to know what your Nexus knowledge is like. So Mike, no experts in the crowd today so far, but we have a lot of people who are following, who know the basics or have somewhat of an intermediary knowledge. So we're going to close this out and we can move on.
Great, thanks. And a good mix of people here. No one to keep me honest, no experts in the crowd. I'll try to be honest anyway. Let's start off with a brief definition of Nexus here. And Nexus, it's just a fancy word. It means link or connection. And it's the link or connection that must be present with the state before state can require you to collect its tax, like a sales tax or a use tax, like a retailer's use tax, or pay its taxes, like an income tax, a franchise tax, or a consumer's use tax. So, a lot of times when I'm talking to people, they confuse Nexus with taxability, or, Nexus is just a link. It doesn't necessarily mean you have to do anything else. It's just this link. You have this connection with the state. Now, if what you're selling is taxable, and you're the one who's responsible for collecting the tax, there's no marketplace responsible for it, and the exposure is material, then you're going to want to get registered and collect the tax. Well, same concepts with income tax. It all starts with Nexus, because if you don't have Nexus, you don't have to take any further steps. You don't have to find out if what you're selling is taxable. You don't have to find out if the marketplace is actually collecting for you in that state. No Nexus equals no problems and no responsibility. So it all starts with Nexus. I think that Nexus is where we want to start. We want to figure out if we have Nexus in a state, because generally, it's a lot easier to figure out if you have Nexus than if what you sell is taxable. So, limit the amount of states by figuring out if you have Nexus there, and then go and do the taxability work, or figure out what the state's rules are, the sourcing rules for income tax. We're going to talk about a couple of sales tax court cases here. We're going to go through them really quickly. A lot of people think that states make this up as they go along, and they do, but they're generally stretching, what the framework is that they're allowed to work in. And the Supreme Court, has decided a number of cases which gives us this, loose framework that the states really have to work within. So one of the first ones, National Geographic versus Board of Equalization. This is important because so many sellers I talk to and their CPAs say, well, when I'm talking to them about their business, they say, well, we have a wholesale side, but they don't work directly with the consumers. We don't collect tax on that, so therefore we're not worried about it. Unfortunately, the states don't look at it that way. And the Supreme Court said the takeaway here is the taxable activity does not have to relate to the Nexus creating activity. So what that simply means, it translates to any activity in a legal entity that creates Nexus for all channels. So using the channel that we were talking about, if you've got a wholesale channel, you got a wholesale reps all over the place. You start selling retail, you haven't crossed any of the economic thresholds yet. So you don't have any economic Nexus, but all of your wholesale reps, they're creating Nexus for you. They're creating Nexus for the entity. In this instance, they would be the Nexus creating activity, and the taxable activity would be your online sales, direct to the consumer. No link between the two, but that would be taxable. So that's a U.S., all of these are U.S. Supreme Court cases. The next one here, so really what that boils down to is once you have Nexus in a state, you need to collect all taxes for all taxable sales or a certificate in lieu of the tax. You can't exclude any channels. All right, so Tyler Pipe, real important one here. You know, this is the second case that the U.S. Supreme Court looked at, and it reaffirmed what they said in Scripto, but I went a step further. And it's about third parties, how people who truly have no connection to you or to your clients can actually create Nexus. Independent contractors, subcontractors. You know, if these are companies that are helping or individuals who are helping to establish or maintain a marketplace, then they're probably creating Nexus. Very important case at Tyler Pipe. And complete auto transit, you know, especially when we're talking to, you know, Amazon sellers. For some reason, Amazon sellers, states don't believe that states don't have the right to tax interstate commerce, or a lot of them don't have. Believe that. And unfortunately, they were right about 90 years ago. Back then, even the states didn't think that they could tax interstate commerce directly. But that started changing in the 1950s or so. And you had all these cases that started chipping away at that concept. So in 1977, we had complete auto transit versus Brady. And the Supreme Court didn't come up with anything new. They basically just, you know, cobbled together all of these previous decisions. They come up with a four-pronged test and basically said that you can tax interstate commerce directly so long as it passes this four-pronged test. And it's a really easy four-pronged test. So yes, since 1977, states can tax interstate commerce directly. South Dakota versus Wayfair. This is one of the reasons why we're all here now. And in this case, we overturned 51 years of precedent. You know, this is the case where, you know, they overturned Quill and National Bellis Hess. These were the two previous cases that said we had to have a physical presence in order to create this link that we call Nexus. And, you know, they went even a little bit further. They said we made a mistake. You know, we never even should have introduced physical presence back in 1967. And that's why we're going back and overturning these cases. It's like they never, ever happened. So what the Supreme Court was afraid of when they overturned these cases is that the states may go all the way back to 1967 because these cases never happened. That's the way that it's looked at now. And South Dakota was smart. They said, we're only going to do this, you know, on a going forward basis. And we're going to come back to that in a second. Just keep that in mind. But what this has done is it's paved the way for an economic nexus, and that's for sales tax. We already had economic nexus for income tax, which we'll touch on later. But this is a brand new concept, or at least it's no longer required, this physical presence. So the nexus for sales tax can now be based on a sales figure. It can be based on the number of transactions. In South Dakota, it was $100,000 or 200 transactions. The Supreme Court didn't explicitly come out and say, hey, you know, this are good numbers. They sent it back to the lower court, but they implied that, hey, this sounds reasonable for South Dakota, but we're going to let you guys work it out at the lower court. So we may see this get challenged again, but as of now, a lot of states have gone out there and have mimicked what South Dakota did. A lot of states, non-taxable sales are included. And here's perhaps one of the most important things. A lot of people I'm talking to right now are getting this wrong. Economic nexus does not override other types of nexus. It's just one more way that the states can come after you. But I get a lot of people saying, hey, you know, I've got a salesperson in California, but, you know, they have a $500,000 economic nexus, so I don't have to worry about being registered there anymore. No, you've got a physical presence. Doesn't matter what your sales are. Economic nexus does not override anything. With Amazon sellers, I've gotten tons of calls. People saying, hey, you know, I'm under the $500,000 threshold. I can deregister now. Well, do you have inventory in that Amazon warehouse in California still? Yes. Well, that's a physical presence. So it doesn't override other types of nexus. And at this point, there are only 2 states that don't have some sort of threshold. All the other states have said something. Most of them have passed statutes, except for Florida and Missouri. Kansas, I say some sort of threshold rather than have passed statutes, because Kansas, they tried to pass a statute. They tried to pass it twice. It was tied to a cut in the groceries. Kansas actually taxes groceries at the full sales tax rate. And they tried to say, okay, we'll get more tax coming in from the marketplaces and everyone else, the online sellers, and therefore we're going to cut the groceries tax. And the governor said, we're not in any shape to be cutting any taxes. We need every dollar's worth of taxes we need. So he vetoed it twice. So the Department of Revenue in Kansas came out and said, we don't have the ability to set thresholds. It's outside our purview. But we do believe we have the right to collect tax on an economic basis. So right now in Kansas, there's, you know, as of October 1st, they want all remote sellers, if you got one sale, they want you to collect it. Now, I think that will be challenged. And I think that whoever challenges it will win, but I think it's a moot point because come the first quarter of next year, I think Kansas is going to fix this, as will Florida. I'm not sure about Missouri. They were trying to tie this to making not the marketplaces collect, but they were trying to make credit card companies collect. So I think that one's got a little bit of a steeper hill to climb, and unless they back away from that, it probably won't pass. My gut feeling is they'll back away from it, and we'll have economic nexus in every state. Here's a chart. There's lots of different information. People say, well, what are the thresholds? Different for every state. And they're changing all the time. There are states like Washington that came out and they copied South Dakota and they said it's $100,000 and 200 transactions. 6 months later, they say, you know what? We think 200 transactions are really low numbers, so we're doing away with that. California had $100,000 and 200 transactions. They did away with their transactions, and they have a $500,000 threshold now. So this is constantly evolving. This is an old slide here. I updated this chart just last night, so it's live on our website. Ellie will get you out a link to it. But it'll tell you what the thresholds are, what the effective dates are, how it's calculated. In other words, do you look at just the previous 12-month sales? Do I look at the previous calendar year? Do I look at the previous calendar year plus the current calendar year? And then also what's included or excluded from the threshold calculation. And again, each state, you know, is different, and they're constantly changing it. Sometimes a state will come out and very little information, and then as they're implementing this, they release more and more information. So this chart is constantly being updated. All right, so I said I'd get back to this. Prospective enforcement. South Dakota said, we're only going to look at this going forward. But it's going forward from their effective date. And that's what the problem is, because some of these effective dates are getting really old. Oh, excuse me. And we're having problems with a number of these states. We just got a letter this morning from one of our clients. Some of our clients say, hey, get me registered. We just figured out we have economic nexus and, we want to be registered as of today. They're registering prospectively. And they did so in the state of Maine. And Maine has one of the earlier start dates. It's July 1st of 2018. And Maine is sending out letters to everyone at this point saying, hey, we don't believe your start date, and you need to pay all of the back tax going back to July 1st of 2018, plus the penalty and plus the interest. So for all the companies who got registered right away, there was no past exposure whatsoever. But now we're getting old. I mean, some of these, look at Maine. It's 12 months old, 14 months old. So this is aging, and companies and your clients and yourself, if you're not registered in these states, you're starting to build liability. And South Dakota is another state. They were the first states that started saying, we don't believe you. And that was, they've got a November 1st start date. So they're going back to November 1st. South Carolina and Wisconsin have started questioning people, not as aggressive as South Dakota and Maine. Those two states right now, they're making everybody go back to the start. I think South Carolina, Wisconsin, not far behind. Eventually, I think a lot more states are going to follow. Now, that's only part of it, because you've got other states like Louisiana making telephone calls just to remind people that they have a responsibility to file for the economic tax nexus. You've got other states sending out letters saying, hey, don't forget about us. Because you've got a responsibility. Those are the nice letters. Those are the nice calls. It's going to get uglier as time goes on. We've got, Utah started calling all of our clients, and luckily they're all registered. And what they told us is they purchased a list of people they think should be registered for sales tax. Unfortunately, a lot of people aren't. Our clients are, but a lot of them aren't. So they're getting aggressive, and they're going out and they are looking for people who are not complying. And other states are going to follow their lead. They're going to be buying lists. They're going to figure out other ways to track people down. So anyway, this is just the tip of the iceberg for this economic nexus here. Now, while these states are looking for the economic nexus, they're going to stumble across all sorts of physical presence, the old stuff. Some of the stuff that some of us may have never known about, and some of us may think that it doesn't matter anymore. But the biggest one that I'm seeing here, and it's been a big one for a while, going back, since I've been in the business, third-party nexus, activities of third parties. There are two Supreme Court cases. We talked about Tyler Pipe, but we've got Scripto back from the 60s. So this is not anything new. And when I'm talking to people, whether they be attorneys or CPAs or actual, companies, they say, how can a third party, someone who's not even connected to me, I have no control over what they do, how in the world can they create nexus for me? Well, unfortunately, the Supreme Court twice has said they do. And the language of helping to establish or maintain a marketplace, that's become umbrella language. It started out as just sales, but now states look at that. Here's a whole list of them, installations, implementation, training, collections, customer service. I could go on, but here's a cheat that I tell my clients. If the independent contractor or subcontractor is interacting with the public, then there's a good chance that that's nexus creating. If they're sitting in a back office somewhere working on software, for example, developing software, as an independent contractor, that's probably not helping to establish or maintain a marketplace, and therefore not nexus. So customer interacting creates nexus. If they're not interacting with the customers, doesn't create nexus. Gets worse. It's not only where they're located, although it's easy to spot those people because you're generally paying them on a 1099, and the IRS sometimes shares information with states, and states will go to the IRS and say, give me a list of everyone who's got a 1099 in our state, because they know that that's going to be creating Nexus for someone, perhaps. And then they look at who's issued the 1099s, and that's how companies are found. So where they live, it's fairly, high on the radar, but where they travel, not high on the radar. But anywhere you have employees or employees, they don't even have the threshold of helping you to establish or maintain a market. Some states, like Michigan, Arizona, there are some, carve outs there, but for the most part, you have people there greater than 48 hours for any reason. Then we're talking about employees here, then it's Nexus creating. Inventory. If I'm talking to Amazon sellers, this is always a big argument, but the states are on firm ground here. I mean, most of these states either come out and say inventory, or they say owning tangible personal property in a state, and inventory is tangible personal property. They say it a lot of different ways, but inventory creates a physical presence. Now, this is where the argument comes in. They say that Amazon's responsible for collecting the tax. Well, that may be true, but that's a whole different argument. Nexus is just a link or connection. Doesn't mean that you're responsible to do anything. Could mean, after checking other things, that you have to do something. But the Nexus argument and who should be collecting the tax argument, two entirely different arguments here. So inventory, just about every state out there says that inventory or owning tangible personal property in their state is Nexus creating. Related entities, I mean, if we're talking about third parties creating Nexus for you, just think how much easier it is if you have two related entities, especially if they're performing services for one another. Now, here's perhaps one of the biggest ones. Nowadays, I get people telling me, well, Mike, we have a virtual office. Everything is done in the cloud, so I'm not located anywhere. That sort of defies the law of physics. You got to be located somewhere. And that's what the states say. So anywhere you live or operate your business from, or wherever you have remote employees. I mean, I talked to a company just this morning, and they said, well, we pay everyone out of Oregon. Well, they're located in Texas. Number one, if Texas finds out, you're not only going to have problems for sales tax, you're going to have problems for payroll taxes, because they're paying payroll taxes in the state of Washington, and they're living here in Texas. So where you live or operate your business from, virtual or other, it doesn't matter if it's a virtual office, you yourself can create the connection. Where your employees are located can create that connection. So just to summarize, physical Nexus is still alive. Economic Nexus, it's not going away. I keep hearing people tell me, well, Mike, the Congress is going to act and this is all going to go away. So I'm waiting on this. Well, here we are. It is June 21st, where we just crossed the 15-month mark, and we're still here. And the exposure, the risk that you have is still growing. So if you're in that group thinking that this is going to go away, that we're going to get Congress to do anything, I just don't see it happening. By the way, we have the temporary Nexus law that Congress put in place 60 years ago. So if we're waiting on Congress, maybe our great-great-great-grandchildren might get the benefit of something Congress does, but I just don't see it happening now. Independent contractors, major risk factor for companies that don't consider themselves to be e-commerce. For companies that do consider themselves to be e-commerce, inventory in an FBA warehouse. Even if you're selling on eBay, remember we said in National Geographic, well, eBay doesn't have a warehouse, but those sales are still taxable if you're also selling on Amazon and you have inventory in that Amazon warehouse. All right, so before we go on to income tax, Ellie, let's go to the next poll question.
Absolutely. I'm launching that question right now. And while you guys are looking that over, I do want to remind you that if you have a question as we go along, please just send it when you have your question. We'll answer all of the questions at the end. You can use that Q&A box that's located in the middle of the screen. And if you're here for CPE credit, please answer these poll questions. Mike, as these questions, they're still rolling in here. Most people are concerned about economic nexus, third parties, travel. I mean, we're across the board, but most people here are concerned about economic nexus. So we're going to close this out and move along.
Okay, the usual answers, a little bit of smattering across the board. Let's go to the court now for some background income tax nexus cases. And this first one, this is important because this is how we got Public Law 86-272. Northwestern Cement versus Minnesota, you know, the company had an in-state office and they had salesmen there and they were soliciting orders of tangible personal property, but the orders were approved outside the state and fulfilled from a point outside the state. And the Supreme Court said these taxes did not violate either the Commerce Clause or the Due Process Clause, which pretty much meant that, you know, it was open season on companies and any state could tax your, your income for a lot of different reasons. And, you know, this was back in the time when it was still believed that you could not tax interstate commerce. So this was big news. And all of these companies ran to Congress and, you know, they were screaming, Nexus is too complicated. You know, this is going to create so many issues. So many companies are going to fail. I mean, we're going to go into another depression. And the depression was a lot closer, the Great Depression, to 1959 than it is today. And Congress reacted. And they acted very quickly, and they passed Public Law 86-272, or the Interstate Income Act of 1959, which basically nullified the Northwestern Cement opinion. Now, look at the facts of this case. Salesmen soliciting orders of TPP, orders were approved outside the state and fulfilled from a point outside the state. That's basically what Public Law 86-272 addresses. It's got to fit all of those scenarios. So it's a very narrow protection. And in today, we have companies offering services in addition to the sale of TPP. And it just doesn't offer the protection today as it did back then. Even back then, it was limited, but much more limited today than it was back then. We're going to get deeper into Public Law 86-272. Now we just are touching on the court cases. Quill was overturned, as we mentioned, in the sales tax. But in Quill, the Supreme Court used language, I'm paraphrasing here, but they said at least for sales tax, you need some sort of physical presence. Well, the states took that to mean that for other taxes, you know, implication, you're saying that you're just talking about sales tax. So for other taxes, it must be okay. And Jeffrey tested this in 1993, Jeffrey versus South Carolina. South Carolina said, okay, the licensing of intangibles are enough to create a substantial nexus. And the South Carolina Supreme Court agreed with that. And they quoted Quill, and they said Quill is limited just to sales tax. Now, this was a South Carolina Supreme Court case. It never got the U.S. Supreme Court never agreed to hear it, never granted certiorari. So this is what we have, but this is where the states are starting to become more aggressive. Now, 1992, we also had, and this is a U.S. Supreme Court case, Wisconsin Department of Revenue versus Wrigley. And this is a case where they were trying to clarify what constitutes solicitation of orders and de minimis activities. And we're going to talk about that. But this was trying to figure out what Public Law 86-272 does and does not protect. All right, so physical presence nexus. Some of the same activities that create nexus for sales tax can create nexus for income tax. I mean, some of the differences are Obviously, sales, which we're going to talk about when we get to Public Law 86-272. I mean, for sales tax, having a salesperson anywhere is going to create nexus, and it may not. And for income tax, independent contractors, there's a difference, where sales tax, they're going to generally create nexus everywhere. For income tax, they may not. But physical presence nexus still exists. And the states don't define what creates it as well as they do for sales tax. Some states simply say any activity not protected by Public Law 86-272 creates nexus. Some states list their protected activities and their unprotected activities, but some states don't. They just have a blanket statement. Any activity not protected. So here is the Interstate Income Act of 1959. As we talked about, it was in response to the specifics of Northwestern Cement. And that's sales of TPP approved outside the state and fulfilled outside the state. Congress reacted swiftly, we said. 7 months they came up with a solution. But they told us this is so complicated that we have to form committees and do studies and we got to get this right. And, this is a temporary solution, but at least it'll nullify the Supreme Court decision. It's commonly called Public Law 86-272. And as I told you, we think of Congress as a do-nothing Congress now. Well, on some topics, they've always been a do-nothing Congress. I mean, you'd think they could get something done in the 60 years since 1959 in this case here. What Public Law 86-272 basically says, states forbidden from imposing a net income tax if all three criteria are met. So in that first sentence there, it's only a net income tax. So if you're talking about the Texas franchise tax, the Ohio CAT, or the Washington B&O, these three taxes are gross receipts taxes. They're not net income taxes. So right there, you've got some limitation. It's states forbidden from imposing a net income tax. If the in-state activities do not exceed the solicitation of tangible personal property. So are you making sales of TPP? Number two, the orders are sent outside the state for approval. And number three, the orders are then fulfilled from a point outside the state. So very specific. If you look at the facts from the case, the Northwestern Cement case, this is based upon those facts. So who does Public Law 86-272 protect? Well, right now, if you're an e-commerce company with a pure economic nexus, or actually, let's talk about that for a second. A lot of people think of this new economic nexus for sales tax as an internet tax. It's not. It's anybody who sells into multiple states. It doesn't matter how you do it. I mean, maybe most of the people who are going to have economic nexus may be selling through the internet, but it could be phone sales, it can be infomercials, it can be catalog sales, it can be, having referrals. Yeah, maybe all you're doing is referrals, and you get 200 referrals, put you over a threshold in a state. So it is not an internet tax. It's anyone who's selling into multiple states can have nexus created just by having a certain number of transactions or a certain level of sales. All right, so some companies, they just have a pure economic nexus. Maybe they're doing drop shipping and they've never had any exposure before. All of a sudden, they've got, filing responsibilities in 40 states. This Public Law 86-272 is going to protect these companies because they don't have any activity in any of these states, so they're going to meet all of those criteria. Then you have your traditional companies. Maybe they do have independent contractors or employees in the state. And if these employees or independent contractors are only soliciting tangible personal property and the orders are approved outside the state and then they're fulfilled from a point outside the state, then, state cannot impose a net income tax. So these are who are protected. Now, let's take a quick look at some that are not protected. Well, anybody who's offering services in addition to selling TPP. So training, installations, implementations, repairs. These are all the types of things that companies nowadays, they can do a lot of. And maybe it's related to this sale or not. Public Law 86272 gives you all or nothing. So even if your sales of TPP are not related to these other services you're performing in state, you don't get the protections. So any company who's offering products and services in a state can't get these protections. Companies with inventory in a state, and I'll actually be doing a presentation at the Prosper Show. It's a big show for Amazon sellers in March of the coming year. I think that this is going to be one of the next big battles that Amazon sellers are going to find themselves in. And, I talk to a lot of Amazon sellers. They say, well, this is news. Even their CPAs say, well, this is news. This is brand new. When did they spring this on us? Well, they sprung it back on you back in 1959. Because an Amazon seller, at least some of your sales are going to be fulfilled from inside the state. Now, maybe some states may have some sort of language that exempts it when it's happening from a third-party warehouse. Most don't. And the plain language of the law says if you have some of your sales, that are fulfilled from inside the state, then you don't get the protections of Public Law 86272. So I think that this is going to be a big problem, especially now that Amazon's collecting for all these states. All the state has to do is say, hey, show me the largest sellers and how much money they're running through here. And then they'll start picking these companies off for income tax. So again, just my thought, put some time out, whether it be 18 months from now, 24 months from now, I don't know what it'll be. Once they digest all of this new sales tax, income tax is going to become a lot bigger issue for them. Companies selling intangibles or services. So a lot of people out there, software as a service companies, they don't get the protections of Public Law 86272. If you're downloading software, you don't get those protections. Companies with a physical presence in a state. And that's, that creates Nexus by itself. And then foreign entities. A lot of states take the position that this was to help, interstate commerce. So foreign entities are foreign commerce, they're not interstate commerce. So they say that Public Law 86272 does not apply to foreign entities. All right, so we're going to talk about the multi-state tax compact. And after before Wrigley came out, they had a list of protected and unprotected activities for Public Law 86272. And afterwards, they updated it, and they're continuously updating it. But the multi-state compact is an advisory compact that takes actions under its authority to make model laws, to make recommendations, to try to make things easier amongst the states on taxpayers, to make things more common. It's not binding. Their recommendations are only advisory. And what the multi-state tax compact did is create the Multi-State Tax Commission, or MTC. And again, policies are only advisory. They promote uniformity. That's what they do with these models they develop. They want uniformity amongst all of the states, make it easier on the taxpayers. And they also perform audits. Now, the guidelines were originally adopted in 1986, so before Wrigley. They've been revised since then a number of times. Again, this is not binding, so states may deviate from what they have out there, but it identifies a list of protected and unprotected activities, and we're going to go into those activities right after this poll question.
Yeah, I'm launching that right now. This is a true or false question. Our question here is, model rule from the MTC is binding on member states. So we'll give this You guys, about 15 seconds, just a quick reminder that you do have to fill out these poll questions in order to receive CPE credit. We have a couple of great questions so far, so keep sending those over. We will answer them at the end of this webinar or follow up with you via email. Mike, these answers are still rolling in, but if you want to go over the answer while they're coming in, that would be totally fine.
The answer is false. It's not binding. They're only suggestions.
All right, great. We're going to close this out and move on.
Okay. So I'm not going to go through every single protected and unprotected activity. There's a lot of them here, but we'll touch on some of them. So soliciting orders for any type of advertising, that's not going to create any type of Nexus. Now, some states say that it creates Nexus, but you're protected by Public Law 86-272. Some states say it doesn't even create Nexus if you're protected by Public Law 86-272. All right, so carrying samples and promotional materials only for display or distribution, all right, without charge or other consideration. So if you're carrying materials and you're going to sell them, that's not protected. You'll see that on the unprotected activities. But if you're just giving them away for display or distribution, that's a protected activity. Furnishing and setting up display racks and advising customers on the display of the company's products. Here comes the qualifier. Without charge or other consideration. If you're doing quality control while you're furnishing and setting up the display racks, well, that's not protected. But if all you're doing is furnishing and setting up the display racks, that is a protected activity. Here's one that surprised me when I started really digging into this stuff. If you own tangible personal property in a state, it is generally going to be Nexus creating, but it's a protected activity for Public Law 86-272. I guess they think, back whenever salespeople didn't use telephones. They did all of their sales by car. So if you were buying a car for your salesperson, well, that's part of soliciting orders. So providing automobiles to salespeople is a protected activity. Coordinating shipment or delivery without payment or other consideration and providing information relating thereto. Well, what that basically means is, so long as you're not being paid to schedule the shipment or delivery, then it's not Nexus creating. A lot of this has to do, if you're doing these activities for free, then it's protected. If you start getting paid to do them, then it's not protected. Okay, checking customers' inventories. Again, we talked about quality control. When you're checking their inventory, for reorder, then it is not Nexus creating. But if you're checking their inventory for reorder and quality control, then it's not protected. Maintaining a sample display room for 2 weeks, 14 days, very specific there. When we get to the unprotected activities, it will say more than 2 weeks. So 15 days, not protected. 14 days, protected. And then recruiting, training, or evaluating sales personnel. That is protected. However, and I just had someone question me on this the other day. They said, what do you mean if I'm recruiting in a state, how can that create Nexus? They were questioning for sales tax, but then they moved to income tax. And yeah, that's actually a protected activity if you're doing it for sales tax. But if you're hiring for any other position or setting up meetings for people who are not salespeople, that's unprotected. It's protected only if you're working with salespeople. All right, so there's a lot more unprotected activities than there are protected activities. There are 20 of these. So making repairs, not protected. Collecting current or delinquent accounts, not protected. Investigating credit worthiness, not protected. Installation or supervision. A lot of people tell me, Mike, we don't do the installation. Well, do you have someone there supervising it? Yes. Well, same thing, not protected. Now, if you're looking at this list here, this is pretty much the same list that is the umbrella for third parties, under the umbrella of helping to establish or maintain a marketplace. So a lot of these activities are the same exact activities. So providing any kind of technical assistance or service, including but not limited to engineering assistance or design service, okay? It's more than solicitation. And resolving customer complaints. I mean, this is a little bit of a gray area there. If it's to ingratiate the salesperson, then that's okay. But if that's just part of your normal job, then no, that's not a protected activity across approving or accepting orders, repossessing property, and then securing deposits on sales. Picking up or replacing damaged or returned property. We started talking about hiring anyone other than a salesperson, or supervising people, and that's where we have it here. And then maintaining a sample room in excess of 2 weeks. All right, so let's go to our last poll question, Ellie.
Absolutely, I'm launching that right now. This question is a little bit longer, so we'll give you a couple more seconds here, but we want to know, PL 86272 protects the company from a state imposing a blank tax in which scenario? Quick reminder, again, you do have to fill out these poll questions in order to receive CPE credit. And please send us in your questions as we go along here. So Mike, it looks like most people are answering option 3 here. If you want to go over that while we leave this open to let a few more answers roll in, that would be great.
We got a smart group. That's the correct answer. We usually get answers all across the board here, so everyone pat themselves on the back. All right, so let's move on to economic nexus for income tax. We mentioned in Quill that the Supreme Court mentioned sales tax, so the states said that, an economic presence is okay. Jeffrey started pushing the envelope. Even if the state says you have an economic nexus for income tax, the states still have to follow Public Law 86272. It's a federal law. It supersedes state law. Now, some of the states with this economic nexus don't have net income taxes. They have, like Ohio, the commercial activities tax, or CAT. So, you still have to follow it, but you're not protected in a state like that. Now, here's something you may find interesting. Only 2 states currently require a physical presence for income franchise tax, Pennsylvania and Texas. Now, there's a factor presence standard, and we're going to go over the 10 states that have this, which is pretty much, a specific dollar amount. And the most of the states, when they're talking about an economic presence, they're talking about the licensing of intangibles. So licenses can create an economic nexus for income tax. But there are only 10 states that actually that have dollar amounts out there. So we've got Alabama, 500,000. And by the way, some of these states adjust annually for inflation. So 500,000 is a number in most of these states. New York has a high number. It's $1 million. Michigan, 350. Washington just dropped theirs from 250 to 100. And Virginia says any positive apportionment factor. So in theory, you get $1. That's a positive apportionment factor, $1 in sales. You could have an economic nexus there. Now, just like sales tax, an economic nexus does not override physical presence or any other type of nexus. So at this point, what I'd like to do is open it up to questions. Do you have any good questions, Ellie?
Absolutely. Sorry about that. I was muted and you couldn't hear me. So yeah, let's get to a couple questions here. The first one, Mike, in In Wisconsin, I recall that if there is no taxable services, no requirement of registering, my question is that even if the non-taxable sales reach beyond its threshold dollar amount, we don't need to file zero returns since no requirement to register. And I think, Mike, are you seeing this question? Can we make it out a little bit?
I don't see it.
It's in the chat box over here. Why don't we circle back and we'll circle back there so we can kind of sort that out a little bit. But if rental equipment is picked up out of state and a customer brings into a state, is it protected?
Are we talking about income tax or sales tax? And here's the thing. Most of these states say if you own property in another state. So it doesn't say who carried it into the state. They say if you own it in the state. So whether you put it in that state or your customer put it in the state or Amazon put it in that state, you own property in that state. So at least in theory, the general answer is going to be yes, that can create Nexus.
All right. Okay. And does the sale of non-tangibles also include music downloads and streaming?
Depends on the tax, depends on the state. So some states define exactly, what a digital good is and whether it's considered tangible personal property or not. Other states don't do a good job of defining it what it is. And some states like to have their cake and eat it too. There may be one definition for sales tax and another definition for income tax. So for income tax, it may be an intangible, where for sales tax, it may actually be tangible, like downloaded software. Texas takes the position that even when you electronically download software, that's tangible personal property for sales tax purposes. Doesn't matter for income tax purposes. But that's those are the types of things that you see. Every state is going to be a little bit different in how they define things.
Perfect. Okay, so let's go to the next question here. So outside of the 10 states who have dollar amount thresholds for income tax, what do most other states use for creating income tax nexus?
It's really different from state to state. Some states actually say anything that's not protected by Public Law 86272. So they don't really pin themselves down a lot. So it's this, if you license software in a state, that can create nexus. But having anybody doing anything in the state that exceeds the solicitation of sales, getting registered with the Secretary of State will generally create it. It's just different for every state, and it's a large list of what can create it. So the best thing to do when you're trying to figure this out is look at those protected activities for income tax. And if it's not on that list of protected activities, there's a good chance that it's going to be nexus creating. That's if you want your general answers, and then you can go to each one of the states individually to figure out if it's actually going to create nexus or not in that state.
All right. Thank you so much, Mike. We're going to close it out here. If you had a question that we didn't get answered, we will follow up with you via email.
Let's go back to that one that was the chat. I found the chat feature here. So.
Okay, great.
Okay, amount thresholds for income tax. What do most other states use for creating income tax nexus? Okay, I think we just did that one.
We're looking for Midori. Her question is about Wisconsin. And she clarified that it's specific to the service. So even if a non-taxable sale reached beyond its threshold dollar amount, she wants to know if she doesn't need to file a zero return, any return, since there isn't a requirement to register in Wisconsin.
Okay, so if you're talking about sales tax and you don't have any taxable sales, then in general, you would not want to register. Why file $0 returns? States don't want to be processing a bunch of $0 returns. Now, you could be not have a responsibility for sales tax, but still have a responsibility for income tax, because if you're selling services, services are not protected by Public Law 86-272. And generally, you know, if you have someone going into the state to perform the services, that's going to create Nexus for you. Or if it's a state with thresholds, you know, any one of those thresholds, the 10 states that we mentioned. Or, you know, if you have a license, maybe you're selling software as a service and you're, you know, it's one of the states that says the licensing itself is enough to create Nexus. So you can have Nexus for income tax and a responsibility to collect and pay the income, to pay the income tax and not for sales tax, and vice versa. So you could have a responsibility to collect and remit the sales tax and not for income tax. And maybe what you're selling is not taxable for sales tax, but it still creates a responsibility for income tax.
All right. Thank you so much, Mike. And thank you, everyone, for joining us today. We really appreciate your support. Please give us your feedback, regardless if you're here for CPE credit. We want to know how you felt about it. Mike, do you have anything else you want to add?
No, I just really appreciate everyone being today. I hope that you can take something positive away from this. Be brutally honest on the feedback. It helps us improve. And if you have ideas for any other webinars you'd like to see us speak about, please give us some suggestions. We want to increase the number of webinars that we are offering. Thank you, everyone.
Thank you, everyone. And again, reminder, if the survey doesn't work for you at the end of this webinar, please don't worry. You'll receive a link to it in 24 hours as well. Have a great afternoon, and we hope to see you next week at our webinars. Bye.
Bye.